Scrolling through financial news, a headline caught my eye. Could the U.S. Treasury issue bonds backed by XRP? My interest was piqued. The idea of the U.S. Treasury, a cornerstone of traditional finance, embracing a digital asset like XRP was intriguing. This wasn't just another cryptocurrency story. This had the potential to reshape how governments issue debt. The proposal, put forth earlier this month, outlined a system where investors would buy XRP directly from the Treasury. This XRP would be locked up for a fixed period, acting as collateral for the bond. In return, investors would receive a predetermined interest rate, paid in either US dollars or XRP. This concept, while novel, builds upon the familiar foundation of US Treasury bonds, a financial instrument understood by investors worldwide. U.S. Treasury bonds are essentially loans issued by the U.S. government. When you buy a Treasury bond, you're lending money to the government. In return, the government promises to pay you back the principal amount of the loan plus interest. These bonds are considered one of the safest investments globally because they are backed by the full faith and credit of the United States. Treasury bonds play a crucial role in the global financial system. They provide a safe haven for investors during times of uncertainty. They also serve as a benchmark for interest rates across various other types of debt. Understanding this traditional system is key to grasping the potential impact of introducing XRP into the equation. Imagine purchasing a U.S. Treasury bond, but instead of dollars you use XRP. This is the essence of the XRP-backed bond proposal. Investors would acquire XRP and transfer it to the Treasury, effectively locking it up for the bond's duration. This XRP collateral would back the bond, much like how traditional bonds are backed by the government's promise. At maturity, investors would receive their principal back, potentially in XRP or US dollars, along with the agreed-upon interest. This innovative approach merges the security of Treasury bonds with the efficiency and transparency of blockchain technology. It's a glimpse into a future where traditional finance and digital assets converge. The potential benefits of XRP-backed bonds extend beyond mere novelty. Blockchain technology inherent to XRP offers advantages like real-time transaction tracking and increased transparency. Every bond transaction would be recorded on the blockchain, creating an immutable record accessible to both the Treasury and investors. This transparency could lead to increased efficiency and reduced costs associated with bond issuance and management. Furthermore, the use of XRP could potentially attract a new demographic of tech-savvy investors familiar with digital assets. It's a way for the U.S. Treasury to modernize its approach to debt issuance and potentially tap into new funding sources. Section 5. Navigating volatility. Addressing XRP's price fluctuations. One of the primary concerns surrounding XRP-backed bonds is the volatility of XRP's price. Cryptocurrencies, including XRP, are known for their price swings, which could deter risk-averse investors seeking stability. However, several solutions have been proposed to mitigate this risk. One solution involves pegging XRP to a stable asset, such as the United States dollar, creating a stablecoin-like mechanism. Another approach could involve structuring bonds with built-in price protections, limiting potential losses for investors. Addressing XRP's volatility is crucial for these bonds to gain traction among traditional investors accustomed to the relative stability of conventional Treasury bonds. Section 6. Clearing regulatory hurdles. A call for new legislation. The regulatory landscape presents another challenge. The United States Securities and Exchange Commission's stance on XRP remains unclear, potentially creating legal hurdles. Existing state regulations, such as New Hampshire's $500 billion market cap requirement for assets backing stablecoins, would also need to be addressed. For XRP-backed bonds to become a reality, clear and comprehensive legislation is essential. New laws would need to be enacted to define the legal status of XRP within the context of Treasury bond issuance. Additionally, regulators would need to establish a framework for overseeing these bonds, ensuring investor protection and market integrity. Section 7. A global perspective. Tokenized debt initiatives worldwide. The United States isn't alone in exploring tokenized debt. El Salvador's experiment with volcano bonds linked to Bitcoin, though controversial, showcases the growing interest in linking sovereign debt to digital assets. Other nations are exploring tokenizing real-world assets like real estate and art, further expanding the boundaries of blockchain technology and finance. Private sector initiatives like Ondo Finance's tokenized United States Treasury Fund on the XRP ledger demonstrate the private sector's willingness to embrace this innovation. These global developments underscore the growing momentum behind tokenized assets, suggesting that the United States Treasury's interest in XRP-backed bonds is part of a much larger trend. Section 8. Beyond the Horizon. Tokenization and the Future of Finance. The potential of XRP-backed bonds extends far beyond a single financial instrument. It represents a paradigm shift, a glimpse into a future where traditional finance and blockchain technology converge. If successful, these bonds could pave the way for a new era of financial innovation, where tokenization becomes commonplace. Imagine a world where stocks, bonds, real estate, and other assets are represented digitally on the blockchain, enabling faster, cheaper, and more transparent transactions. The road to this future is paved with both opportunities and challenges. The United States Treasury's flirtation with XRP-backed bonds, while just a first step, is a significant stride in that direction.
Hey there, folks. Tonight we're diving headfirst into the thrilling world of bonds. Yeah, I know what you're thinking. John, you promised me car chases and explosions, not financial instruments. But trust me, this is way more exciting than it sounds. Imagine this. You're sitting at home, sipping your beverage of choice, and you glance at your super futuristic financial dashboard. It looks like something straight out of Minority Report, with sleek lines and glowing numbers. But instead of tracking Tom Cruise, it's tracking bond auctions. Yep, you heard that right. This dashboard shows you, in real time, exactly how much governments are borrowing, who's lending the money, and at what interest rate. It's like watching stock tickers, but instead of Apple or Tesla, it's the US Treasury or the Japanese government. Riveting stuff, right? Now, you might be wondering, John, why on earth would I want to watch bond auctions in real time? Well, my friend, that's where the magic of blockchain comes in. See, blockchain is like a giant public ledger that everyone can see. It's incredibly secure, transparent, and tamper-proof. By putting bond transactions on the blockchain, we can create a system where everything is out in the open. No more shady backroom deals or hidden fees. It's like having a financial watchdog that never sleeps, ensuring that everything is above board. Think about it. More transparency means more accountability, and more accountability means less corruption and more efficient use of public funds. That's a win-win for everyone, except maybe for those who benefit from the current system's opacity. But hey, you can't make an omelette without upsetting a few eggs, right? Remember the good old days when financial transactions involved, actual paper? Back when traders would yell at each other on the floor of the stock exchange and bond certificates were physical documents locked away in vaults? It's almost quaint, isn't it? Like something out of a history book. But the truth is, the financial world has moved on. Today, it's all about algorithms, high-frequency trading, and complex financial instruments that would make your head spin. And bonds? Well, they're still stuck in the Stone Age. It's time for bonds to catch up with the digital revolution. It's time to ditch the paper and embrace the power of blockchain. It's time for a future where public finance is as transparent and efficient as a well-oiled and hopefully less ethically dubious machine. So, how do we actually make this happen? How do we drag bonds kicking and screaming into the 21st century? Well, it all starts with something called tokenization. Tokenization is basically the process of converting something, in this case, a bond, into a digital token on the blockchain. Think of it like turning a physical dollar bill into a digital dollar in your bank account. It's still the same value, just in a different form. Now, imagine a world where anyone can buy and sell government bonds with just a few clicks 24/7. No more waiting for banks to open or dealing with mountains of paperwork. It's like having a global bond market right at your fingertips, open to everyone. This could revolutionize the way governments raise money, making it easier and cheaper for them to fund essential services. It could also open up new investment opportunities for individuals, allowing them to diversify their portfolios and potentially earn a better return on their money. Section 5, a tale of two tokens balancing stability and innovation. Now, I know what you're thinking. John, this all sounds great, but isn't cryptocurrency like super volatile? What happens if my government bond token suddenly crashes and burns? Well, that's where things get a little more complicated. To create a stable and reliable system for government bonds on the blockchain, we need to think about a dual token approach. One token would represent the bond itself, while the other would act as a stable coin pegged to a real-world asset like the US dollar. This way you get the best of both worlds, the stability of a traditional bond with the flexibility and efficiency of blockchain technology. Of course, there are regulatory hurdles to overcome. Governments will need to figure out how to regulate this new market and ensure that it's safe and fair for everyone. But hey, that's what regulators are for, right? Section 6. Navigating the regulatory landscape, a tightrope walk. Let's be honest, the relationship between governments and crypto is complicated. It's like that couple who's constantly fighting but just can't seem to quit each other. Governments love the idea of controlling everything, and crypto is like, hey man, have you heard of decentralization? But look,
check one.
We need some rules here. We need to protect investors, prevent fraud, and make sure this whole thing doesn't go completely haywire. Think of it like building a roller coaster. Yeah, it's fun to go fast and upside down, but you want to make sure it's structurally sound first. The good news is there are already solutions out there. Things like zero-knowledge proofs, which allow for verification without revealing sensitive information. It's like magic, but with more math. The point is, we can have our regulatory cake and eat it too. It just takes a little creativity and a willingness to embrace new ideas. Section 7. Liquidity is king, the importance of deep and active secondary markets. Okay, so we've got our bond tokens, our regulatory framework, and our fancy dashboards. But there's one more crucial piece of the puzzle. Liquidity. Liquidity basically refers to how easy it is to buy and sell something without affecting its price. Think of it like this. If you're trying to sell a house in a ghost town, good luck finding a buyer. But if you're selling a house in a bustling city, you'll have plenty of interested parties. The same principle applies to bonds on the blockchain. We need deep and active secondary markets where these tokens can be traded quickly and efficiently. This will ensure that investors can easily buy and sell their bonds, which in turn will make the entire system more stable and attractive. Section 8. The emerging market advantage. Leapfrogging into the future. Now, you might be thinking, John, this all sounds very futuristic and utopian, but let's be real, the US government is about as likely to embrace blockchain as it is to admit that pigeons are government drones. And you know what? You're probably right, but here's the thing. The US doesn't have to lead this revolution. In fact, it might be the emerging markets that take the lead. Think about it. They're often more open to new technologies and less burdened by legacy systems. Imagine a country like, say, Singapore launching a blockchain-based bond platform. Suddenly, they become the go-to destination for investors looking for a more efficient and transparent way to invest in government debt. It could be a game changer. Section 9. Trust, the ultimate currency in a digital world. So, there you have it. The future of bonds, brought to you by blockchain. It's a future where public finance is more transparent, efficient, and accessible to everyone. But as with any technological revolution, there are challenges to overcome. The biggest challenge of all, trust. See, financial systems are built on trust. We trust that our banks won't run off with our money, that our governments will use our taxes responsibly, and that the value of our investments won't evaporate overnight. In a world of blockchain and cryptocurrency, we need to find new ways to build and maintain that trust. We need to ensure that these systems are secure, transparent, and accountable. We need to educate ourselves and each other about how these technologies work and how they can be used for good. So stay informed, stay curious, and most importantly, never be afraid to ask questions. Because the future of finance is being written right now, and it's up to all of us to shape it. That is, unless the pigeons get to us first. And then, well, all bets are off.